This video covers a critical accounting skill called analyzing business transactions or analyzing business events. In this video, we are going to go through the 4 different ways that you can acquire an asset and the 4 different ways that you can use up an asset in business transactions. Remember that assets are the resources that are owned or able to be used by the business. In this first example, let's first start with going over our formulas again. Remember, here is your balance sheet formula. Assets always have to equal the liabilities plus the equity. But remember that equity has a number of different ways that affects equity. Remember, owner investments, which we're going to end up putting in this column. I'll discuss that in a minute. Owner investments make equity go up, and net income makes equity go up. But net income is a formula also, which is revenues minus expenses. And then owner's withdrawals also makes equity go down. So we're going to discuss these formulas again as we move through the examples. All right, let's go with, in the first example of acquiring an asset, we're going to have that the owner invests the asset. How we're going to record when an owner just gives the assets into the business is we're going to add to whatever asset the owner gave, asset or assets, could be plural, and then we're also going to add to equity. But because various things affect equity, we're going to have a column called the owner's capital account. And owner investments or owner contributions add to the owner's capital account. Notice we have added to the assets and we've added to the equity under the capital column, and that will keep our accounting equation in balance. Notice this equal sign here. We always have to keep our accounting equation in balance. For the next example, let's do that the business obtained the asset through going into debt. In this case, we add to the asset and we also add to our liabilities. Remember, liabilities are debts or obligations. Again, if you add to the assets and add to the liabilities, your accounting equation will be in balance. In the third example, the business obtains the asset through the business activities, whatever activity or event they said they're going to do to be in business. Once again, we're adding to the asset, and in this case, we're adding to the equity, but we're going to put it under our revenues column, because if you earn assets through business activities, that is the definition of a revenue, which is inflows of assets by being in business. The fourth and final way that you can acquire an asset is actually when you exchange one asset for another. Notice in all 4 cases of our acquiring assets, we have a plus in an asset column because obviously we got an asset. But in this 4th example, when you exchange one asset for another, one asset column is going to go up, that's why I have a plus sign here, and another asset column is going to go down. So I'm trying to show that one column goes up, one column goes down. Notice on an asset exchange, you have both added and subtracted the same amount to this left-hand side of this equation that I have, meaning that you don't do anything over here on the right-hand side of the equation. You just add one asset minus another asset. That is a short description of all of the 4 different ways you can acquire an asset. Now we're going to move down to the 4 different ways you can use up an asset. And notice in this case I have minuses in my asset column because using up an asset is obviously going to minus an asset. I wanted to be parallel, so I decided to put an exchange of one asset for another in both the acquiring assets and in the using up of an asset because, as you can see, it's falls into both of those categories. Let's move on to the second way that a business uses up an asset or an asset goes away. We can use up assets to pay off debt. In this case, again, the asset is going down and the liabilities are also going down, which would keep your accounting equation in balance. The third way assets are used up in a business is to pay for business activities. In this case, your assets are going down, whatever asset it was, and you also need to make your equity go down. This is kind of confusing up here when I say equity because multiple things affect it. So in this case, we're going to minus in the expense column here. It's a little bit confusing because technically it's not a negative expense. Every time an expense is incurred or happens in a business, it ends up ultimately minusing from equity. So that's why we're showing it as a minus there, because it makes equity go down. And finally, if the owner withdraws any assets for their own personal use, that would make the assets of the business go down, and we have to again record that as an owner's withdrawal, which again makes equity go down. Now let's briefly review our financial statement formulas. Notice these two columns here, which I have outlined in purple to match back to my other handout, which had the income statement or the profitability statement, is revenues minus expenses. That's our income statement formula. So that goes on our income statement. And then net income, which is the excess of our total revenues over our total expenses, would give us a positive net income. Remember, if we happen to have expenses greater than our revenues, that would create us to have a net loss. Now let's move to the statement of equity. The statement of equity then has the beginning equity balance plus any owner's contributions, which would be recorded in the capital column. And then we have to add our net income and minus our withdrawals. And so all of these columns here are the numbers that you would see on the statement of equity then. Finally, our third and final financial statement that we're covering in this discussion is the balance sheet. The balance sheet is assets equals liabilities plus equity, and that is in essence everything, because we would have to list our assets and our liabilities, any debts or obligations, and then the ending equity capital number is this amount that came off of the statement of equity. And that is our starting off with the accounting skill of analyzing business transactions.